Good morning, everybody. This morning, three topics, three global macro topics. The first one is what is happening on gold. You probably heard that. A major technical breakout on gold prices, which was something we were expecting since a long time. Then we are going to see the impact and what's potentially happening on the US dollar. And we'll end with some comments on US 10-year bond yields. So first of all, if we start with the chart of the week, it's obviously the chart of gold. As you can see here, a major upside breakout above a resistance line which was forming since 2013-2014. So quite significant technical event, and obviously the market did not ignore this breakout, so we saw a very strong upside acceleration just after the FOMC meeting, with prices reaching very quickly the initial Fibonacci resistance at 1380, which is a 38% retracement of the entire decline between 2012 and 2015. And I see that as a pretty bullish signal and as an indication that gold prices are likely to continue their rally in the medium term. The next target being the next Fibonacci resistance at 1484 and potentially even higher to retrace 1.8%, which is slightly below 1600. Also keep in mind that this more or less reverse head and shoulder, it's not a perfect reverse head and shoulder, but let's say it's a rounding bottom, is giving a potential target. So it's even above 1600 and potentially in the 1650 area. So a lot of upside targets available on gold, and a rally which is likely to continue in the medium term. The impact is quite obvious on the US dollar because, as you know, there is a strong correlation between a reverse correlation, a negative correlation between gold and US dollar. So the fact that gold is breaking down is not a good news at all for the US dollar, and suggests that we may start to see a correction, a sustained correction on the US dollar. And this is quite important and confirmed by price action. We discussed this chart already last week. I was mentioning the technical bonds on the rising 200-day moving average. That's something we saw at the start of this week. So a pretty good technical bounce from the 200-day moving average, which was tested last week. But as you can see, a failure to confirm this technical bounce. So the fact that we saw renewed weakness at the middle of this week after the Fed is quite negative, I would say, for the US dollar, and suggests that this time the US dollar index, so DXY index, is likely to break below its 200-day moving average and extend the correction at least to the initial Fibonacci support around 96 and potentially even lower. The downside risk being between 95 and 94.50. So significant trend deterioration on the US dollar, so over the last few days, so it's quite young, and at least I think bulls should be much more cautious on the US dollar than before. If we look at euro dollar, so the outlook is quite similar. What happened this week is prices bounced off the 112 area, which was for me a critical support zone. So this critical support zone was broken down before the Fed, which looked quite bearish for the euro dollar, but we had after the Fed a very strong reversal, which makes me think that this time the technical bounce is likely to be sustained, and something probably more significant than the bull trap we saw previously this year. So you can see in January, February and March. This rally looks stronger in light of yesterday's recovery. So in the short term, maybe we are going to see a pullback, but longer term, I think we are more likely to see euro-dollar breaking above its important resistance line and possibly even above 113.50, which is the 200 moving average. So improving outlook on the euro-dollar and deteriorating outlook on the US dollar. Yeah, last chart I wanted to show you about the dollar crosses, major dollar crosses, is US dollar against, British pound against the US dollar. So a significant derating of the pound against the US dollar of the last few months. But as you can see, a successful test this week of previous lows. The lows of December and January. Formation of a bullish divergence on the euro side, so that's quite encouraging for bulls on the British sterling, and the fact that first Fibonacci resistance was hit very quickly, so in just a couple of days, is quite encouraging as well. So I think that we are likely to see a bottom forming above 125 on the cable, possibly a pullback, but higher probability now to go to the next Fibonacci resistances between 128.40.50 and even higher around the 200 moving average at 129.30. The last chart I wanted to show you is the one of US government 10-year bond yields. You know this chart, I showed you numerous times, and this time what we are seeing is that yields are reaching 2%. 2%, as you can see here, is a very important pivotal zone and has been for a long time. So I think what would make sense from here is to see the start of a technical bounce. So not necessarily a big trend reversal, but at least a stabilization attempt above 2% and possibly start of a mean reversal to 220. You can see there is a gap here, which means that it would be a perfect target for a technical bounce. My conviction in such a move remains quite moderate, I would say, because until now the momentum has been incredibly strong on bond markets, not only government bonds but also high yield, emerging bonds. So this is clearly a very, very strong market, and the problem is that this market is strong but aggressively overbought, which means that sooner or later we are going to see a mean reversal move. And is this mean reversal move going to start around 2%, or are we going to see low yields before seeing start of a taking profit moves? I don't know at this stage. But all I can say is that the bond market is very, very important for equity investors. It was the main driver of the recovery on equity markets over the last few weeks. And if we start to see profit taking on bonds and US bond yields bouncing off the 2% area, then we are probably going to see a continuation of the trading range on equity markets and a false breakout on the S&P, because you saw that yesterday the S&P moved back to new highs. So personally, it would be the scenario I would favor for the coming weeks. So false breakout on equities and confirmation of a trading range with profit taking on bond markets. So that's something that is not happening yet, but that will be something to closely monitor within the next week or two. Thank you very much for your attention and have a great trading day.